It is Wednesday, January the 23rd, 2019. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through, so therefore we'll pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing in the charts. A reminder before we begin, do not trade from any of these slides. They are strictly for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's macro online updates. The research document this month updates the global regional developments. Therefore, the slides this morning will focus on our other three report areas of our monthly report: global risk, macro, and U.S. economic developments. In this monthly Under the Lens video, I would like to discuss Mattis 2019 tipping points, themes, and our just released 2019 thesis on de-dollarization. What we identified going into 2018 were 44 tipping points, with 11 categorized as high risk. High risk has traditionally been approximately 5 to 7 in size, but became the largest we have had going back to pre-dot-com era, when we first started tracking tipping points on a site specifically called Tipping Points. Our tracking methodology was unquestionably telling us that global risk and U.S. risk was at extreme levels. This didn't mean that something was going to happen imminently, but was suggesting that a small spark could set off major destabilizing shocks. That subsequently happened the first week of February 2018 and again in Q4 after October the 4th. Both were major moving events of risk reversal, or our number one tipping point. As we begin 2019, our highest risk tipping points surprisingly remain the same and could best be described as now only a very much darker shade of red. Generally, our overall list of 44 tipping points remains about the same, with some such as de-dollarization, growing social unrest, and with it populist governments and major shifts as a consequence in government policies, and corporate bankruptcies, to likely soon shoot much higher in our rankings in our current estimation. The policy shift of the global central banks is impacting a significant number of our tipping points. The global financial markets are so highly over-leveraged from a protracted period of easy credit that to start withdrawing the incredible levels of liquidity is a serious issue to global financial markets, which has never been attempted before. Few fully know what to expect. This chart shows what to expect from an era of QE following on. What it doesn't overlay is an era of QT. Maybe we need to consider that QT is really too much too soon, but that's for another discussion. It has always been the role of the central banks to take away the punch bowl, just as the party got going. But this has been a humdinger of a party that has been going on for a decade now, specifically since the 2007-2008 financial crisis. There is going to be significant, unprepared fallout if the central banks actually follow through with their announced policy guidelines of normalization. The bond market doesn't believe the central banks will do this. As a consequence, it is now starting to shake the bond market with volatility not normally seen in this particular market. We see the potential for major long-term reversals occurring in 2019. The wild card, of course, and I need to stress this, is the central banks adopting further, untested monetary policies, and this being triggered by even the possibility of what I'll refer to as QE for the people, or direct fiscal stimulus, or helicopter money. We expect the EU to take center stage in 2019 as the great experiment proves to be flawed, and the adjustments required are not acceptable to ever-increasing social unrest and rising populist governments. We are already in the final stages of the credit cycle, and this is something to be watched closely, along with a reversal later in 2019 in the US dollar. There is a real possibility that the credit cycle may be extended further thanks to coordinated central bank policies. This is something, again, we are carefully monitoring. Inequality and social unrest is clearly evident with populist governments, and a shift to the left increasingly more evident. Inequality at number 12 has risen because of the disparity between who has been winning and who has been suffering through the asset bubble created by the central bank's sustained easy money policy. The top 5% of the population that owns assets have won big. The bottom 95 have not, while experiencing the inflationary effects in the form of higher health care, education, housing, rental costs, and salaries not keeping up with the cost of living. This is now leading to potential growing social strife. The ability to handle debt loads has become a major problem that must be dealt with, or it will be dealt with itself in crisis fashion. We are seeing the shift away from a unipolar world, which we outlined in detail in our Thesis 2018, A New World Order, and the expectations of de-dollarization outlined in this year's thesis paper. We have a continuously slowing growth rate of the global savings pool. This problem will increasingly become a serious impediment for the financial markets in regards to securing of sufficient investment capital, and maybe even more importantly, new, unencumbered, and non-rehypothecated collateral. This problem is central to the big reversal theme we'll talk about a little later. The gutting of the working middle class has been a theme of ours for a few years now, but we now see it to potentially be a destabilizing tipping point. The degree to which the U.S. has become a subprime economy, the levels of household indebtedness associated with payday loans, home equity loans, student loans, credit card balances have left U.S. consumers strapped for discretionary income. In a 70% economy like the U.S., this is a serious problem that could be even more aggravated with a cyclical overdue recession and advancing forms of job replacing robotic automation. The U.S. consumer has long been the mainstay of the U.S. economy, and for that matter, the post-World War II global economy. A weakening U.S. consumer is something the world has never experienced and is ill prepared for. We have talked extensively about zombie corporations this year and the level of corporate debt growth. During the next recession, it will become a major issue and, in fact, may trigger the global recession or a global recession. Not to go through all 44 tipping points, but I do think it is important to mention that items like cyber attacks and the resulting unknown complexity failures should not be ignored. Often major crises arise from something in common view, but is taken for granted until it suddenly tips the scales and rapidly destabilize markets and economies. One of the many reasons that the tipping points are important to our work is that it forms the basis for launching our abstraction methodology, which is the foundation for many of our investment theses over the years. We share these with you as part of our Strategic Investment Insights, or SIIs, that thinking, and the associated watch lists that go with them. They are not recommendations, but rather simply outputs from our research for your consideration. We take the tipping points shown here on the left and try and identify patterns and relationship groupings. These we then, over the course of the year, attempt to synthesize into ideas or concepts that may not be self-evident. Our Mata SII themes section videos, such as Under the Lens and Long Wave, articles and papers, macro maps, etc., are tools which are all part of the work we do during this process, which we share with you through our ongoing postings. The culmination is our annual thesis papers listed on the right. Last year, it was the New World Order. This year, our abstraction methodology has highlighted, as I mentioned earlier, de-dollarization. This is a natural byproduct from the expected shift from a unipolar world to a multipolar world and laid out in our 2018 thesis paper, The New World Order. We're going to talk more about it in a moment, but before we do, I would like to take some time to talk about some of the shifts in our themes section, which is part of our abstraction methodology. These are some of the key new themes which our process has isolated as we begin 2019. You will notice immediately that they are heavy in the political and global sphere, just as we expected they would be. We didn't pull them out of the air or from the nightly news. They came from our 2018 year-end tipping points and themes that we were growing throughout 2018. Last year, we identified these important relationships, which we shared with you. We refer you to last year's Under the Lens video, which can be found and referenced on the Mata SII website. We talked about the economic groupings and abstraction, as well as the political groups and abstraction, This year we have highlighted further developments. Our red tipping points are clearly pointing in the area of economics and an end to the current credit cycle and economic expansion phase. A major reversal lies ahead. Developments in the area of de-dollarization and supporting last year's groupings of major financial dislocation can be seen. This in turn supports the abstraction of a big reversal and destabilization of the status quo. In the area of political groupings, the degree of social unrest, whether the yellow vests in France or U.S. political polarization regarding immigration in the U.S., are supporting our abstractions of mounting policy extremes and political upheaval. In blue, the 2018 thinking regarding trade conflicts and protectionism has only further intensified, accelerating de-dollarization due to the weaponization of the U.S. dollar by the U.S. to maintain control, basically, of its unipolar worldview, whether by design or consequence, that's to be determined. One of the many roadmaps we have laid out to assist us with identifying themes to watch for is shown here. We've shared this with you in previous videos. This is a sequential roadmap with key blocks or trends we should be expecting. There is no time frame with it as it depends on the sequenced events. We could spend a lot of time on this graphic, but we don't have time for that today. To position what we should expect, it needs to be built on a clear framework of where we have come from. Growth and debt. First, when you start to consume more, you produce, or simply choose to live behind your means, you obviously start to build up debt. You have a lack of savings and soon have slowing rates of productivity improvement in the overall economy because of a lack of investment into productive assets. Sound money removal. It isn't long before the economic system is forced to move to a fiat currency system to keep the economic system afloat. Improvements in standards of living slow, capex expenditures slow, and the velocity of money steadily falls. The economy is forced towards financialization as macroprudential monetary policies such as financial repression are adopted by the powers to be. These policies force unproductive risk-taking, poor lending practices, malinvestment, and excessive levels of leverage into the economy. Policy problems. Soon, public and fiscal and monetary policy issues become center stage to expediently handle the unintended consequences. Kick the can down the road seems to become the solution of the day to avert continuous crisis. If any of this sounds familiar, it is because that is where we are today. As the requirements for the growth of financial investment grows to support debt and leverage levels, the slower growth rate of savings becomes a bigger and bigger problem. Government policy programs consume larger amounts of the productive assets and the savings of the economy. Soon, a shortage of new collateral to secure new borrowing becomes a real problem. Instability makes existing collateral values more volatile. This leads to even a greater shortage of lending collateral. A fiat currency failure is what then starts to loom. What soon happens is the currency of the economy becomes exposed as foreign lenders call into question the collateral value underpinning the economy. As the currency begins falling, hyperinflation begins. Hyperinflation is first and foremost a currency event. It rapidly accelerates with governments having few options left. Social strife. Like Venezuela today, social strife soon consumes daily life as one failed attempt after another is foolishly tried until the economy resets in a devastating fashion and policies of sound money are forced to be restored in some fashion. We then look at a new order. The crisis fosters new systems, new policies, and even new institutions. You can see from the red mark in the center star where we feel we are today and what therefore likely lies ahead. The big reversal, the area I label as rising rates, comes about as part of the big reversal I mentioned briefly earlier, and we will see as something we are looking for over the next 1 to 3 years. Again, I'll talk a little more about it in a moment. The big reversal is centered on shifting global demographics, capital investment, and savings level, pending entitlement payouts, and borrowing demand or supply. Investment will continue to grow, but the rate will slow slightly, driven primarily by the maturation of the capital intensiveness of industrialization. Simply said, it takes less capital to start a factory than start a software company. The growth rate of savings, on the other hand, will also slow, but at a faster relative rate. This is driven by an aging population and a slowing birth rate. Entitlement program promises are coming due in a massive way, and we need it to be funded. There are $84 trillion in unfunded and underfunded U.S. government entitlement requirements alone. Supply generation of debt is going to balloon. At the same time, the funding availability for demand will be crimped. The results can be expected to be rising funding rates and a shortage of unencumbered collateral to support new lending and debt creation. This is a roadmap you have no doubt seen before. We've had it since the financial crisis when we first put it together. The 2007-2008 financial crisis effectively took place in the upper left corner. To possibly be oversimplistic, it was primarily U.S. housing-centric and financial in nature. Yes, it had spillage around the world, but it was primarily a Federal Reserve and U.S. government problem. Since the underlying problems we felt were not fixed at that time, we felt that the central problems would only grow and issues would become economic in nature and much broader and regional in scope. By 2012, in fact, we had massive banking problems across the EU, Greece, and even down to Cyprus and the East Bloc nations impacted by poorly capitalized and unsound European banks. It has been our view and continues to be that this is leading to even greater numbers of problems, which will be both political and global in nature. If we are correct, then our tipping points and emerging 2018 and 2019 themes should be signaling this, and they are. We still expect a global crisis within the next few years in the risk-free, investment-grade, and high-yield bond markets, centered around the $550 trillion over-the-counter, unregulated global swaps market for currency and interest rate hedging. It is almost a foregone conclusion. Only the timing is really in question. I'd like to shift now to some discussion on our 2019 thesis paper, De-Dollarization. Our paper is over 154 pages and is extensive in laying out what is presently occurring globally regarding de-dollarization. We lay out what the key drivers are to de-dollarization underway, what actions countries are taking, important new developments, alternative to the US dollar, as well as what the global outlook is as a consequence of this. What we see in this simplifying illustration is we have a tidal wave or tsunami approaching here on the left, which is a fiscal wave of unresolved problems, unfunded entitlement programs, economic inequality, a generational pensions crisis, growing budget deficits, falling productivity, slowing money velocity, and supply of money. This in turn is facing pressures on the right from debt saturation at all levels: global debt, sovereign debt, corporate debt, and household debt. The problem is that the entire global system is based here in the middle on the determination of the pricing of risk via the U.S. 10-year Treasury note. It is considered the risk-free baseline. This is becoming increasingly flawed through monetary policies such as quantitative easing. What is worse is that the entire edifice is built on the U.S. dollar. Our 2019 thesis paper lays to rest the precarious exposure this now represents to the global economy. A CEO once quoted on how his company went broke and described it as slow at first, then all of a sudden. What we see as a result of de-dollarization is a slow-moving glacier, a glacier that will take us in 2019 and 2020 in our estimation from stage 1, shown here, to stage 2. We have trade wars, that is, tariffs acting as a U.S. consumption tax, unfunded liabilities coming due, underfunded pensions coming due, contingent liabilities in the $210 trillion fiscal cap being triggered as the global economy slows, falling productivity, reducing standards of living in the developed economies, employment income growth continuing to fail to support middle class and the bottom 40% lifestyles in the U.S.'s 70% economy. U.S. now faces its first recession in over a decade with a highly leveraged corporate debt level. The results of falling productivity because of consumption versus investment of savings will lead to stage 3. This will be marked by a steady decline in standards of living. tax revenue shrinking, fiscal expenses mounting, U.S. dollar begins to weaken with advanced de-dollarization and U.S. credit downgrade, price inflation becomes a concern, economic stagnation can't be fixed by deficit stimulus, a sudden and unexpected surge in sovereign debt is experienced. The U.S. experiences hyperinflation and a crack-up boom as the currency loses its exorbitant privilege. U.S. dollar falls significantly as confidence is lost in the U.S. economy and leadership. Price inflation surges as goods become more expensive. Yields rise rapidly. Government funding expenses soar. And by 2025, in our estimate, the U.S. dollar becomes part of a global reserve currency basket. All of this comes with a lot of pain. This illustration is what investors and traders, in our estimation, should take away from de-dollarization. The U.S. long bond is going to rise over the next few years while equity prices fall, assuming, of course, and this is a big assumption, central banks don't launch a whole new approach to financial repression. The U.S. will enter a period of elevated inflation, possibly by the end of the next decade, hyperinflation. We should expect to see asset deflation in the U.S. with parallel price inflation. Basically, we will see asset prices deflate for those things we want and normally finance, while prices will rise for those things we need but normally don't finance. Remember, when assets prices fall while rates rise, it means you get less for more. Capitalism gets you more for less. The consequences of socialist programs and entitlements eventually result in you getting less. The thesis is available now in the subscriber section of the MATA SII website. So in closing, as I always remind you, remember the answer will be and continues to be they'll print more money. It is the only answer politicians will ever agree on until no one, of course, wants it or trusts it. And I think this program this year, de-dollarization, is central to understanding one of the ways this is going to come about. Therefore, invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2019 turn out to be an outstanding investment year for you and your family. And I thank you very much for listening.